Hello and welcome to Deal Flow, the show that tracks merger and acquisition activity in Africa and beyond. We looked last week at corporate and investment activity in the mining sector across Africa, where there's been a great deal of interest out of China. In fact, the interest from Chinese investors in African assets generally has grown dramatically over the past decade and is expected to stay strong. We look in this week's show at the likely future trends in Chinese M&A activity across Africa. More on that in a moment. Let's take a quick look at our deals of the week. Nigeria's First Bank has completed the acquisition of the West African operations of Switzerland's International Commercial Bank Financial Group Holdings, a move that will help expand its international footprint. South African agricultural company Zeder Investments agreed to pay $27.5 million for a Zambian maize and wheat milling firm. Glencore Xstrata started trading on the Johannesburg Stock Exchange last week, where the mining and commodity trading group has secured a secondary listing. US Airways and American Airlines finally have been given the green light to merge. They now are the world's largest airline after they agreed to give low-cost competitors more access to several US airports, including New York and Washington. According to Mergermarkets Deal Drivers Africa report, 3 of the biggest African M&A deals so far in 2013 have been from Chinese investors in the energy, mining and utilities sectors. In studio with me to discuss current trends in China's investments in Africa, ENS Africa's Head of China Practice, Ernie Lai King, and from London, Kristina Thompson, Editorial Research Analyst with Remark, the publications and research arm of Mergermarket Group. Welcome to both of you. Ernie, as a matter of interest, it's interesting that ENS has resources devoted to business with China, and that's what you head up.
That's correct, yes.
So plenty of activity. There
is, you know, as ENS has the largest China desk of all the South African law firms, and it started about 2 years ago. I've been involved in the China practice for longer than that. I was previously with another law firm before coming to ENS, and I'd had previously another 4 years of China experience before that. So in terms of what we've seen over the last 6 to 7 years, there has definitely been an uptick in investment.
So Kristina, that's anecdotal evidence and experiential evidence of China's interest in Southern Africa and in Africa. What does your latest research show?
Our research does show that Chinese investment in Africa is still definitely in its infancy. This year we only had sort of less than 10 deals tracked in Mergermarket. But Mergermarket deals only track investments $5 million USD or over. But this is a 4-fold increase from the year before, and China is now the biggest investor in Africa by value. So when they're going in in a big way.
Kristina, by sector, what are the trends that you're seeing?
Absolutely. It's very concentrated in energy, mining, and utilities. Chinese investors are definitely looking for sort of natural resources to meet China's internal demand for things like energy and iron ore.
And Kristina, just from your vantage point, how does the sectoral interest from China compare with some of the other big players looking for assets and deals in Africa?
Obviously, energy, mining, and utilities deals are dominant among inbound investors sort of across the board, but China's is very sort of concentrated in this sector to the exclusion of literally everything else. We haven't seen any other sort of deal from other sectors in quite a few years, really, since the downturn. So it does sort of seem that Chinese investors have concentrated their efforts in this sector.
And Kristina, just a last question to you, and hopefully your to picks this up, but has there been a trend or a shift in the nature of the Chinese deals in Africa in terms of full ownership moving perhaps down to just a significant stake in some of these deals?
Absolutely. Most of the deals we've seen this year have been Chinese state-owned companies taking a minority stake in African businesses. This is easier for a lot of reasons. Most of them revolve around meeting regulatory approval is so much easier when you're taking a minority stake in something that has issues around resource nationalism tied to it.
Kristina, good talking to you. Kristina Thompson is from the Mergermarket Group. Ernie, so you've heard all of that research,
yes,
and
yes.
does this correlate with your own experiences?
Not quite. Perhaps merger markets statistics are a little bit behind. We've seen in South Africa, certainly right across the board, not just, although there is of course a concentration to an extent in mining, utilities and energy, but we've seen it at the moment right across the board, from real estate with regards to, and I refer to the very, very recent deal of Shanghai Zendai, to telecommunications, which is Top TV, to heavy vehicles, energy, but right across the board.
I think the point is, as Kristina said, that their research tracks only the bigger deals, so falling out of their scope then would be some of the sectors that you indicated. So what you're saying is that the interest from China is across the board. It's not just minerals and resources, but it's also anything exposed to the consumer. Yes,
quite. And these are deals that are over $5 million. But they are right across the board. I mean, there's some really large mining deals, absolutely. There's one that we're working on at the moment, potentially $5 billion US.
And your experience on how the nature of these deals might have shifted over the last decade or so. So anecdotally, and we know China had the reputation of coming into various African countries and closing deals with governments and almost doing the deal at that level. Is that true in the first place? And secondly, is that changing?
That is absolutely true. One of the first things we advise our clients coming into South Africa is South Africa is very different to doing business compared to the rest of Africa. In the rest of Africa, it is possible to do deals on a government-to-government basis, and deals are struck at that level. There's not that much need for legal advice, for example, because the deal is done on a government-to-government level. Concessions are made in terms of local laws, etc. But that's very different to South Africa. In South Africa, the deals are done at the private sector level, not at the public sector level. And that's one of the first things that we tell our clients when they come to South Africa. It's a different environment, completely different environment. And one thing about the Chinese investors, they do learn very quickly. So they have adapted quite quickly to the South African landscape, and quite comfortably as well. All they need to know is the rules of the game. Once they understand that, they adapt and they play according to the landscape of that jurisdiction.
What's your opinion of the risk appetite of Chinese investors, whether private or from state-owned enterprises in China? If one looks at M&A deals across Africa and in emerging markets, it seems as though much of the appetite is coming from the BRIC countries. So, in other words, from other emerging markets who might understand the risk profile.
Yes. If you look at the private investor versus the state-owned enterprise, we've seen quite a dramatic shift where more and more of the private investor is coming in, what I call the second wave. There has been, over the past, a concentration of state-owned enterprise interest in South Africa, but more recently we've seen more and more private investors coming in. As far as risk is concerned, it's hard to pigeonhole investors into any particular risk category. But if you look, for example, at the Shanghai Zendai deal, most people would say that's quite a risky deal. As far as that developer property company group is concerned, they had the whole world to go look around. They decided to come to South Africa. I'm quite sure there are people saying, well, South Africa seems a little riskier than other jurisdictions, but Mr. Dai from Shanghai Zendai nevertheless chose South Africa. Generally speaking, the Chinese investor does tend to be quite conservative as far as risk is concerned, but it's difficult to pigeonhole.
And to generalize. And what about horizon? Are their horizons longer, or again, would that be a generalization?
Their horizons are definitely longer. Their horizons are definitely longer than the Western investor. So while we may look at a 4 to 5 year horizon, they're looking at 10 to 15 years.
Again, this may be a generalization, but it seems as though Chinese investors in Africa have a negative reputation. Is that justified?
I think there are certainly cases where that criticism is justified, and there are cases where it's not justified. One of the criticisms that you hear all the time is that they don't pass on the economic benefits, that if they're doing a deal in an African country, and they have a construction deal, for example, that they send in their own teams, they create their own villages, and then at the end of the project they fly out, and there's very little local involvement involved, local consultants and employment involved. I think the criticism has been noted and recorded by the Chinese. So when I speak to them as far as South African investment is concerned, I do warn them of that perception, and that they need to be careful of how they operate. And of the larger deals that I've been seeing, there has definitely been a passing on of economic benefits, hiring of locals. So the one thing that they do is they learn and adapt very quickly.
Ernie, in closing, what shifts are you seeing, and in a way encapsulating all that we've spoken about in how the deals are structured, how they're financed, the sectors and the deal sizes?
Chinese companies generally have long pockets, so as far as financing is concerned, it's quite interesting that the first thing they want to do is they want to introduce the funding through equity funding. And then you say to them, well, you know, there are other ways to structure it. You know, you can have a mix of debt and equity and various instruments that you can use, preference shares, etc. And but generally speaking, there's no shortage of funding. You know, as far as spreading of risk, to start looking at local institutional fundraising. Generally speaking, when the larger deals, that I've been involved with, generally tends to look at their self-funding capacity, and then afterwards maybe looking at local funding, but a preference for equity funding.
And is there a match then with local companies, so the potential targets, is there a match in appetite for debt, rather deal structuring then?
One of the interesting things that we find in our practice is the language issue and the cultural issues. So notwithstanding that your Chinese client, who sometimes, as a matter of pride, will say, we'd like to carry on in English, when we get to the difficult, complicated parts, I insist that we switch to Mandarin, because you know, when you're dealing with local partners, the cultural differences and the language differences between the South African partner and the Chinese partner can be quite wide.
Right. And you're quite reliant on excellent translators then, I would assume.
Absolutely.
Ernie, thank you for coming, and really
Sure.
good to hearing your perspectives on Chinese investments in Africa and South Africa. Well, that's a wrap of this week's edition of Deal Flow. My thanks to guests Ernie Lai King from ENS, as well as a bit earlier we had Kristina Thompson from Mergermarkets. Be sure to tune in again next week when we hone in on M&A activity in Africa once more. Until then, from me, it's goodbye.